Hey guys, welcome back. It's Josh with the Financial Advisor Car Guy. So this week we're going to talk a little bit about real estate. Now I'm going to start by telling you I am not a realtor and I'm not a mortgage lender. But about a year ago, I did a video on your home being the biggest asset in your life. And while that really hasn't changed a whole heck of a lot, property values have come down and mortgage rates have gone up. Now, a lot of that has to do with the Feds moving interest rates around a lot this year. They've been trying to combat inflation and to some extent slow the economy and all those things. And I would say your housing prices, housing values are all having a hard time staying where they once were because of it. So I can tell you, my own personal home, if I were to watch Zillow, it's down somewhere between 10 and 12% from today 1 year ago. Now, I'm not moving, I'm not buying or selling or doing any of those things, so the market really doesn't impact me personally a whole heck of a lot. But it might impact you or it might impact somebody you know. So what I wanted to discuss a little bit today is the mortgage interest rates and how that kind of controls the entire market. Now, once again, I'm not a realtor. I'm not a mortgage lender. I'm just going to tell you from a financial advisor's perspective what's happening in the housing market. Now, values fluctuate. Neighborhoods fluctuate, right? So if I live in a really nice neighborhood, my house might be worth more than if it were located in a different neighborhood. Sometimes there's a premium to live in a certain part of town. Sometimes there's a premium to live on a certain street even, things like that. And when you're dealing with interest rates, you're at the mercy of what your monthly payment might be. So if we're talking about, a really high-end home, $1 million home, if you need 20% down to qualify for that loan, what does that mean you need in the bank? $200,000. Now, when there's a recession or a looming recession or even just financial hard times, how many people do you think out there have an extra 200 grand sitting in the bank that they can use as a down payment? Yeah, you're right. The answer is not a lot, not a lot. Now, where people that are somewhat immune to this, they're going to pay cash. They're going to pay cash through good times. They're going to pay cash through bad times. They're not so worried about interest rates. They're not even worried about what the down payment's going to cost. Because if they can buy a $1 million home and pay cash for it, then they're going to do that. Now, the truth is, they love times like today because you or I, or normal people who need to finance their homes and aren't paying cash, we might not have 20% down, or maybe we do, but we might not go after a certain house because of the interest rate. If I have to borrow at 8% to buy a new home, I might just stay content with what I have for the time being, and maybe I wait a year or two before I change locations, right? So what ends up happening is people that have cash buyers, they love it when the inventory slows down and isn't moving, especially in a high interest rate environment, because what ends up happening is, if I'm a seller and my house is not selling very quickly and I need to reduce the price to get an interested buyer approved, maybe now my $1 million house, I'm going to sell it for $900,000. So I'm going to take a 10% hit just so I can sell the house. Well, add into that the idea of a cash buyer. Now, a cash buyer is, again, not going to care what interest rates are. They're going to likely just pay cash for that house, whether it's $900,000 or $1 million. But if they can buy $1 million house for $900,000, they've effectively saved or made $100,000. So if you're a cash buyer, now is a prime opportunity. It is absolutely a perfect time to pick up real estate because it's at a little bit of a discount and you're not battling people bidding over asking price. That was a thing a year or two ago. People were going way above and beyond asking prices, and they could afford to because interest rates were at 2 or 3 or 4%. So they weren't paying a ton of interest. They were willing, knowing that the housing market is increasing 5 or 6 or 10% a year, they're willing to go up and above and beyond the asking price by 4 or 5 or 6%, knowing that within a year's time, they're going to make that right back. So the housing market has changed a fair amount. Values are down, interest rates are up. So when interest rates are up, housing market is slow. So that's the other thing of it, right? Is realtors. You're going to see mortgage lenders going away. You're going to see realtors potentially go away or consolidate. And that's what we're seeing with some banks, some lenders. Even in my community, my town, there are a couple of banks that have merged, or the lending programs have merged or gone away entirely. And, realtors, I would say, are probably next, unfortunately. There's just not as much inventory today. Things are staying on the market a bit longer. It's becoming a much more competitive industry. And I think you're going to find that just there are some realtors out there that just can't, maybe they didn't have the volume, or maybe they didn't have the clientele to stay through more of a trying time, and they may just change industries or careers altogether. And then you've got the big volume realtors that maybe are slowing down. They're not doing the same volume, but they still have, maybe they still have a good clientele that does pay cash for a property or does continually look for rentals or, whatever it is. And so I don't think the whole industry is not going to collapse. You're not going to see every realtor be looking for a new job. But it might be something where, because that particular sector of the industry is slowing down, you might see your realtor friends taking extended holidays. Maybe they're not going to work the month of January because there's no houses listed or whatever. And so, take that for what it's worth. But do know that rising interest rates do tend to slow the economy. And this is a great example of that. If a $1 million home, all of a sudden I've got to pay a 7% mortgage instead of a 3% mortgage, my monthly payment is up a lot. I mean, a lot, right? Like more than double? Maybe. No. I'm sorry. The interest portion of that payment is more than double. So, I mean, now we're talking, I don't know, maybe a $6,000 mortgage is a $7,500 mortgage, or a $7,000 mortgage might be a $9,000 mortgage. And, that's so much money. So much money. It's ridiculous. So interest rates do play a role, especially on these bigger dollar homes. So what happens on a smaller wage, right? On a smaller scale house? In my town, an entry-level home a year ago was about $400,000. I would say today that house is probably $325,000 to $350,000, maybe, which means it's more than 10% down. It's probably 15 to 18% down. And again, they're sitting on the market a little bit longer, but that's still an entry-level home. And for someone in Oregon who's making, let's say minimum wage, and I'm not even sure what minimum wage is. I think it's about $14 or $15, $14.50, something like that. You're making $30,000 a year. Your mortgage on a $300,000 house is probably still $1,500, $1,600, $1,700 with a reasonable interest rate. And then on top of that, you've got taxes and insurance. So now all of a sudden, a $300,000 house might be costing you $2,200 a month. And, do the quick math on that. That's $27,000 a year. And if you're making, what did I say, 15 an hour, that'd be like $30,000 a year. Literally 90% of your income is covering your mortgage. It's not easy to qualify for that type of deal. And rent is just about the same as far as the cost goes. A very modest 3-bedroom, 2-bath house to rent is something like $1,500 a month. So signs of the times. It's a challenge right now. Real estate is a challenge. And I know it's that way everywhere. It's not just that way here in Central Oregon. It's not even that way here only in the Northwest. It's just all over the US. That's the pressure we're feeling. And as long as interest rates continue to rise, we're going to continue to see this problem in the real estate market. So I'm hoping that by the end of 2023, here's the plan, the feds will start reducing interest rates. They're going to pull back. And if that happens, mortgage lending should follow. Along with that will be auto loans and other things, other types of loans. But I think it's going to take the feds really pulling back on rates for us to see a real reprieve. And I would say in the meantime, the housing market's going to remain a bit volatile. Buying a house is still not a bad investment. Generally over time, property does increase in value. But right now interest rates are a big hindrance to a lot of people. So be mindful of that. Still sit down with your financial advisor, your banker, your mortgage lender, your realtor. Still talk to people about what your options are, because again, just because rates are high does not mean that you can't refinance. There's a lot of programs out there where you can refi 6 months, 12 months down the line, and they're bundling that price in now so you don't have to pay for a refi later. You might pay a little bit more in interest in the next 6 or 12 months, but after that, hopefully if rates come back down, you can lock in a 30-year loan, maybe at 4.5% or 5% or something like that, which is a lot better than 7.5% or 8%. So again, I'm not a mortgage lender. I'm not a realtor. This is just the mortgage industry through a financial advisor's eyes. This is what I see. This is the conversation I'm having with a lot of clients, and it gets asked all the time. So I felt like doing an episode on this stuff is important. So hang in there. Let me know if you have any questions or concerns. Merry Christmas, Happy New Year, but most of all, may every investment you make be a good one. Till next time.